In the midst of interest rate meetings as we are, as of the time of recording, we're just awaiting the European Central Bank to decide on its latest thoughts on rates for the Eurozone. Then we've got the Fed and the Bank of England. One must be mindful of the direction of inflation. And one of the big drivers of inflation has been what's happening with fuel prices, oil prices particularly, although natural gas as well contributing, of course, as we know, especially since the war in Ukraine. Let's take a look now in some more detail about the direction of travel for oil and work out just what sort of contribution it's likely to make to the future thought on interest rates and, of course, the overall groupthink, if you like, using the phrase from our guest coming up now about what's happening in the markets and what people are thinking. Let's turn now to Ron William from RW Advisory. Groupthink, what a great word. And this is one of the words you want to talk about. But this relationship between oil and inflation obviously is key.
Yes, it is. I mean, particularly when it looks like we're peaking in inflation terms in the short term. Mm-hmm. And certainly the central bank meetings ahead will be a useful indicator for that. But when we look at the charts in terms of the technical setup, there could be, at least in the energy crude oil space, a crude oil reawakening that will likely lift inflation levels either into year end and certainly the new year, and challenge that group think in terms of consensus that could be on the wrong side of this trade.
We've got the chart here of West Texas Intermediate. You can dial this into the IG trading platform by putting in US crude. But the direction of travel is there to be seen.
Well, it's been sideways for close to a year. Technically, it is a base pattern which is recovering higher. We can all see that surge above the old resistance level, now support around $83 on your chart. And most importantly, the long-term, medium-term and short-term averages crossing higher, generating a bullish crossover. And the last time we saw that happen was actually middle of last year. So that's clearly a milestone bullish signal. And then just to add the MACD indicator there, measuring momentum, all above the zero line bullish territory, suggesting that we are in a bull trend early stages.
And of course, the whole point of discussing this with you is to work out where oil is going in the long term. And you've brought along a number of charts. Let's overlay some more technical analysis on this and ask you the question: what stop-off points you think where we are along the way, using WTI or West Texas Intermediate as the base?
Yes, we're going back to that recovery base pattern, which is surging higher. You can see the surge on the green indicator at the bottom, looking at the rising number of consecutive days and weeks. And so we're in that next upsurge, which actually coincided with the negative seasonality window of September, the so-called September effect, where volatility usually kicks off. We're already seeing a little bit of a correction in the equity markets, and that seems to be adding some support in the commodity space. And then looking at the chart itself, according to the chart and price that I'm looking at, around that old resistance level, now support, $88 on West Texas, while the market holds above that, or whichever variation of that people see, while it holds above that level, the expectation is for a minimum price objective to 105. So the $100 psychological mark is a clear and present target, and we would need to hold above current levels in order to maintain it. Keep in mind the moving averages, which are now bullish across long-term, medium-term, and short-term, and the seasonality, which seems to suggest a supportive environment for oil right now as we speak. And on the left of the chart, just to quickly highlight, these are statistical overlays, just highlighting additional value price areas which tie into the ones I mentioned.
You talk about groupthink, you talk about the way the market talks. What about investor sentiment?
Well, investor sentiment typically supports the trend, particularly if it's the smart money. And in this case, according to institutional smart money, they have been surging higher, reshifting their stance on oil to bullish for the second half of this year. You can see it's from historic lows. So we've shifted from extreme bear now to bullish. There are different reasons for that, but clearly it means that they're putting their money where their view is, and that is supporting the market as we speak. We're still at the 60 area and can still push higher. So that's further upside potential based on smart liquidity flows in the market supporting oil.
What about the move likely into the end of the year? We move using West Texas Intermediate as the base. There is this shift, isn't there, between what we use for heating oil in the winter, or rather driving fuel oils in the summer. You then have a shift around in the output, and it then goes into heating fuels. We don't know how cold the winter's going to be. But what sort of cycles are we expecting going into end of year?
Well, certainly seasonality patterns do support the energy market in terms of the summer driving season and then the heating winter time. This cycle overlay is statistically driven based on spectral analysis developed by the Foundation Study of Cycles, FSC, and that signals the time pattern. The surge that we're seeing now, which actually was predicted from the summer lows, so potentially that's summer driving season expectation. But what's interesting now, it's highlighting two potential scenarios. Either one, we get an upside surge right here and now, where it's all front-loaded into the short term, or the biggest and best part of the move will likely happen into the new year. So elevated oil prices across the board, but a question as to whether we get a fast move now or the bigger and best part of that move early in the year. So suggesting a potential negative divergence over the next few months that we should be aware of.
Talking about where the markets are going, quite often you look at potential highs and lows. You get the sort of fan chart effect almost, catering for the excesses of either direction. What are the chances of a commodity super cycle in this space, do you think?
They're increasing right here and now, and that's why the short-term timing is something that we can have a reasonable amount of threshold evaluation on, because ultimately we're setting up for a once in a lifetime surge in commodities, and that's what we see on this ratio chart, which is commodities relative to equities, and we can see every generation or so, quite literally a decade or more, there is a swing from one market to the other. Paper assets to hard assets and vice versa. The last time this happened was in 1999 at the tech bubble, and before that, 1972, the Nifty 50 stock bubble. So there was a time also during the 80s, but the key point here is it doesn't happen that often. It is generational, and often it happens when monetary conditions are extreme, debt has built up, and ultimately we need more tangible assets as a medium of exchange, particularly when one asset class has been undervalued for so long. At some point, that mean reversion risk skews in the other direction.
I'm keen to follow up on the next chart, because your next chart is highlighted inflation expectations are depressed. We've gone through this period now, as I said, where interest rates are rising because of a reaction to upward facing elevated levels of inflation. But you talk, if we bring up the next chart, inflation expectations depressed. Explain more about this in the context of what we're talking about.
Well, this is the historic contrarian group think right now as we speak, showing institutional sentiment at historic consensus expectations for lower inflation, depressed inflation, lower than we've seen in a decade, certainly since the 2008 global financial crisis. Partly because there could be the expectation, mainstream expectation, that central bank policy has peaked out in inflation. Also, potentially that economic cool down ahead will lead us to a different direction in terms of the path of inflation. And perhaps they think that the best or the biggest of the move is now done. Having said all of that, it does serve as a contrarian risk, particularly when contrasted with the other charts that we've been looking at, and most importantly, this crude oil energy breakout that we're currently looking at.
How about some of the macro fundamentals? What are we looking at there to support the case for higher oil prices?
Well, although the view is technically driven, it is always part of a cross-asset macro framework, and that helps for big picture strategic perspective, but also correlations. And we can see here that there are interesting cross-asset correlations right now, especially with interest rates, long-term 10-year yield in the US breaking to the new cycle high above 4%. That will likely be a short-term interim high, according to the chart analysis, but nevertheless, it is further inflationary pressure on the long end, and you can see there with the gap and catch up between oil and 10-year, that could suggest further upside pressure for commodities in general, but oil in particular, especially after that 50% drawdown on oil, which would increase the skew to the upside.
Well, that's an interesting point as well, isn't it, about stockpiles? The drawdown we've seen a lot of evidence recently from the American Petroleum Institute, from the EIA, all suggesting that we're using an awful lot more oil that's coming onto the market. So you've got this economic fundamental reason, I think, obviously for high points. What would you say about the stockpile part of the argument?
Well, this is a rare mix of technical, macro, and fundamental factors all aligning. And the last part is exactly what you just highlighted there. Supply side squeeze and depletion when we look at oil stockpiles. Then if you look at oil stockpiles globally, that's the blue line, looking neutral to depressed, but certainly at the lows. But where it's a lot more accentuated is when you look at US crude oil based on their strategic petroleum reserves, which are now at 40-year lows. So general supply side is squeezed following OPEC cutbacks, Saudi and other nations, which are big players in the field. But also when you apply US, that adds a further pressure point there. And of course, restrictive policy in the US has led to that. But either way, supply side depletion, extreme lows will likely increase demand and pricing pressures.
Let's talk about one more chart and take a look at another comparison between oil and stocks generally. What's your observation around that part of the market to view?
Well, for traders and investors looking to jump on the opportunity, the markets that performed the best last year, just to look back as a context for now, was the US dollar and the energy index. But nothing moves up in a straight line forever. And of course, the energy index has since been in a 9-month or so consolidation pattern. Up until now, it is now 5% away from its extreme highs. And that will also likely indicate further positive catch-up for the oil market, which is about 48% away. So whether we hit that mark or not, even half of that is a substantial gain in the market, and a good way for us to do a top-down analysis of the price projection for oil versus the energy index. The other thing is it also highlights the likely rotation between growth and value. And so if we think about the darling buds of tech having done so well this year, and surprised most, including myself, in terms of their comeback, how much more can they do? What is the encore? And certainly, they are, the leaders holding up the index. If and when they start to turn, we're already seeing that in Apple and Netflix. What next? And so I think the rotation is key as part of a portfolio readjustment, and as the next opportunity as some of those risk assets start to unwind.
Yeah. Okay, Ron, we've got to leave it there. But thanks indeed for joining us with your view on the oil markets and the interaction with inflation and the way we will think about it and what our expectations are. That's Ron William from RWA.